Hello and welcome back. My name is Connor Tumblin. I serve in the investment committee here at the Retirement Guys Formula. And today I'm going to be sharing with you one of my favorite strategies called Capital Leaders. Here are our disclaimers. And if you'd like, you can take a minute and pause the video and feel free to read through all the disclaimers that we have. And now for an overview. What is Capital Leaders? So this is an all stock portfolio that strives for long-term growth. It invests in companies with strong balance sheets. So by this, we mean they have high cash levels, over $1 billion of cash. They have low long-term debt to equity ratios, less than 30%, and they have over a 15% return on equity. This portfolio has a risk score of about 74, which puts it in the growth category. And this 74 is an objective metric generated by the software Riskalyze. The number is based on the level of potential downside risk that the portfolio faces, and it ranges from 0, which would be very safe, to 100, which would be very risky. So at a 74, this is a pretty high risk, high growth portfolio. It is also updated at our investment committee's discretion. So this means that the holdings are switched in and out to ensure that they still fit the portfolio's methodology. So we look, do they still have a high enough level of cash? Do they have low enough debt and high enough returns on equity, among other things? And then of course, the weightings of the holdings are rebalanced periodically to make sure that they're still relatively equal weighted. So here's why I like this portfolio. Imagine we have two families, the Smiths and the Millers. The Smiths, on one hand, are financially disciplined. They keep cash on hand for a rainy day. They don't take on loads of debt. And they only make wise purchases on things that they're going to get a lot of use out of and things that they use efficiently. And then the Millers, on the other hand, they're quite the opposite. They spend all the money they bring in, saving none of it. They max out their credit cards and they only make the minimum payments on them. And then they're always making impulse purchases on things they're not going to get a lot of use out of. Now, suppose that a brutal recession comes and one of their income earners is out of a job. How are these families going to end up? So the Smiths, they were wise enough to set money aside and keep themselves free from being buried in debt. So they're mostly able to get by unscathed. But the Millers, without any cash on hand and a lot of debt, they quickly succumb to their huge debt load and are forced to sell their house and their car, which was bought by the Smiths and other similarly cash-rich families at a large discount. So the Smiths are a great representation of the companies we include in the Capital Leaders portfolio. Well-capitalized companies are in a much better position to weather the economic storm rather than companies with huge debt loads and low cash levels. And sometimes even the struggling companies go out of business or they're even bought out at big discounts by companies in a better financial position. So now getting into more of the portfolio's tendencies, how does it react statistically wise? So with a beta of 1.01, this portfolio reacts to market events very similarly to the S&P 500, which is what we use as our broader market index. So for reference, a beta of 1.0 would mean that it moves in strong correlation to the market. So at 1.01, it's very similarly moving to the S&P 500. During periods of high growth, capital strength tends to slightly outperform the market, and during periods of broader downturns, capital strength might slightly underperform the market. This is just a general summary of how the portfolio will probably perform. Now getting into the portfolio statistics, these numbers are also generated by the software Riskalyze, and they represent with a 95% certainty the likely range of returns over the next 6 months using historical data. So say the year is 2020 or 2021 when things were going very well, the portfolio might be up as much as around 30%. But say the start of 2022, the portfolio is not going to be doing well most likely, and it might be down as much as 16.4%. This is just the 95% probability and doesn't always include those outliers. So maybe during COVID, for example, it might be down more than this 16%. The distribution rate for the portfolio is 1.42 on an annualized basis. And the expense ratio, since it's an all stock portfolio, would be 0. And this does not take into account the management fees that you pay to your advisor or Retirement Guys Formula. Finally, the key takeaways for the Capital Leaders portfolio. It's great for people looking for long-term growth, but to get this long-term growth, you have to accept a moderate to high risk level. And since it's an all stock portfolio, there's no additional expenses beyond the management fees that you pay to your advisor. This would assume that you use a no transaction fee account at Schwab, which would be standard with their firm. So finally, let's get in touch. If this portfolio is of interest to you, I'd encourage you to reach out to the professional who showed you this video, or you can call us here at the Retirement Guys Formula at 419-842-0550. Our headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. So again, thanks for joining us. I'm Connor Tumblin here from the Retirement Guys Formula, talking about the Capital Leaders portfolio. Have a great day. We look forward to getting in touch.